Welcome back to FreightWaves Live at Home. I'm here with Doug Waggoner, the CEO of Echo Logistics. Doug, how are you?
I'm good. How are you, Craig?
Doing well. How are things in COVID world impacting Echo? How are you guys dealing with it?
Well, we were able to rally into the work at home mode, and we've got 2,600 employees all working from home, and it's actually gone pretty well. It's amazing what we've learned in this time about our ability to work from home. And I think the other thing that's interesting is just kind of the esprit de corps that it's created, with everybody having a common purpose of getting through this and serving our clients and taking care of our carriers. So, it's been a challenge, but it's also been kind of exciting to see everybody rally.
Do you think this is a permanent opportunity for Echo? Do you think parts of your operation will stay remote, or is the plan to get back into the office as soon as feasible and safe?
We're comfortable in this environment, and I think as the various states clear their orders to go back to work, we're going to take it slow. We're going to follow the federal guidelines in the 3 phases. But we're also going to make it voluntary. So I think initially, when we open up one of our offices, it'll be available to those that want to come back to work. And for those who want to continue working at home, we're going to allow that, and probably into phase 3. And at some point, I think we'll get everybody back to work. But we're going to just take it slow and let it kind of happen organically. But I do think it causes us to question, going forward, do people need to come to work 5 days a week? Maybe in a city like Chicago, where you can have a 1.5-hour commute one way, maybe it's a great fringe benefit of working for Echo to be able to work from home for 1 or 2 days.
Yeah, I mean, I have a 15 commute in from my house here in Chattanooga, Tennessee. Most of our staff is probably not more than 20 minutes. But we've had the same conversation whether we would make this permanent. We were looking at adding office space here in Chattanooga prior to COVID, and we certainly have reconsidered that. We're not going to do it anytime soon. But we've actually talked about, does it make sense for us just to stay permanently in some type of capacity work from home? So I imagine this is a pretty consistent opportunity for folks in all businesses to evaluate it.
Yeah, I mean, one thing that we've noticed for myself, as well as talking to a lot of our people, we're more productive from home. Not only do I gain back, in my case, 3 hours of my life every single day from commuting, but I don't have as many interruptions. You try to have an open door policy, and people show up unannounced, and you invite them in, and you have a 20, 30-minute conversation. But unfortunately, that conversation occurred in the middle of something that you were doing, and now you've got to restart and figure where you were and get back in the groove. And I'm a lot more productive at home, and I'm talking to more people. I'm reaching out. I'm reconnecting. I'm talking to people at all levels of the company. I'm talking to people in the industry, and so for that, I feel actually more productive. And I've heard the same thing from a lot of people.
I'm in the same boat. I have a new infant. He's 1 year old. He passed his first birthday was just a few weeks ago, and I've spent more time with him in the last month than probably his whole life before that, just because he's at home, we're at home, and it's been wonderful. I don't know how for you as CEO running a company, but certainly for me, I am more relaxed than I remember being in a long time.
Yeah, I mean, if you're given the stress that we're all in right now, I've been able to stay pretty calm and pretty relaxed, and I think it's just because there's good work-life balance at the moment. Spending time with the family, having a few more hours in the day to work or do whatever, and it's been helpful for me, and I think a lot of people feel the same way.
So Doug, let's talk a little bit about the freight market. We saw a massive surge of activity in the month of March, and then we saw this dramatic drop-off really for the last couple of weeks. What did you guys experience during the surge, and what are you seeing right now in the market?
Yeah, I think we're seeing that exact same thing. On March 16th was our first optional day that you could work from home, and a couple of days later, our governor announced that it was mandatory. But for that week and the following week of March, we huge surge in demand, largely from food and beverage type companies that trying to get their products to market, some of the shortages that were going on in the grocery stores, et cetera. And so we saw truckload really strong. And then as more and more states started closing up and sending people home, we saw, first of all, the glut of truckloads started to slow down in the first week of April. And then LTL for us really took a big hit because, a lot of our LTL clients are small and mid-sized companies. And what we found is a lot of those companies are simply closed. And in other cases, people aren't buying the products that they sell. So we've seen pretty major hit in LTL. Truckload has slowed down. But the good news for me is it seems like it's leveled off. And in fact, the last week even starting to pick up a little bit. So I said on our earnings call last week to investors that, to us, it feels like it's going to be a U-shaped recovery. I think there are some that are predicting a V and there's some that are predicting a W, but I don't think it's an L. And so as we start to, come out of that U, the question is it a wide U or a narrow U? And I think we've hit the bottom.
Yeah, I actually share that sentiment with you. Zach Strickland and I are going to have a debate about this regarding whether or not we've actually hit that bottom and whether or not the market's going to recover. I certainly share your view that we've hit the bottom and probably did last week. And while I don't expect an acceleration of demand, I certainly expect that we'll see better conditions going forward than what we have seen.
Yeah, I noticed something interesting, and you may have studied it more, but, Georgia went back to work on Friday, and we saw some signs of some tightening capacity in the Southeast, and I looked at the Sonar outbound load tender rejection index for Georgia, and it actually ticked up the last couple of days. So to me, that's encouraging that, as states come back online, maybe there's a backlog of freight that's going to come with it.
I think so. I mean, I think one of the things that I'm looking at is the automotive sector. I mean, it's such an important part of our industrial manufacturing side of our economy, and it drives so much freight, whether it's the automotive suppliers or the automotive manufacturers themselves. I think as those come back online in mid-May, I expect we'll see a lot of expedited shipments, and really that becomes, for me, the restarting of the U.S. economy.
Yeah.
So Doug, what are your, I mean, you've talked about a U-shaped recovery, but what is Echo doing right now as volumes have dropped off? We've seen a lot of companies look at how they're optimizing their business around technology, starting to automate a lot of the workflow and processes. How are you guys using technology to sort of, or this opportunity right now to think about your business going forward?
Well, I would say that, we've never stopped using technology. We have a pretty robust technology and data science roadmap that we've been working on for some time, and we've increased our investment this year. So even without the COVID-19 crisis, we had a plan. Now, since the crisis has occurred, we've tightened our belt a little bit. We've made some cost reductions, but one area where we've not held back is in IT and data science. And in fact, we're kind of at a phase in our development cycle where we're starting to push a lot of the new functionality into production. So it's very timely for us. That technology does a variety of things. In one sense, it's valuable to our shippers who can be more automated if they want to. Same for our carriers with our carrier portal and mobile apps. But also internally, there's a lot of new Echo technology that's rolling out over the next few months that's got a lot of internal productivity aspects to it. And so all those things combined, I think, just make us a lot healthier in the future, regardless of what the economy throws at us.
So Doug, as you think about, as the economy comes back, inevitably it will, what does this mean that you won't have to add as many human resources in the future? Perhaps you'll be able to use technology to augment and grow with less requirement to add heads as you grow?
Yes, we had new sales classes that were going to be starting in March, April, and May, and we've delayed all of those, and we'll probably downsize them. But our vision going forward is that we can book a lot more shipments with the same number of people. So, over time, as the technology rolls out, as we get adoption from our partners, we would expect to be a lot more productive and be able to do more work with less people.
What do you think is going to happen to this industry? I mean, we've seen a lot of, in particularly the brokerage 3PL industry specifically. Last year, there were a number of trucking asset-based carriers that went under. We've seen a lot of the freight brokerages that have cut back in staff and have right-sized to the current state of the market. But I also would expect we're seeing a lot of compression and consolidation happen in the industry. I mean, what are you hearing from your peers, and what do you expect to see in the brokerage industry in the later half of 2020?
Well, I'm not sure how everybody is doing right now, but we've kind of got our heads down, focused on what we're doing. But I think bigger picture, you're going to see continued embrace of technology. Obviously there's a bit of a technology arms race going on at present. I don't think that's going to stop. I think one of the challenges that you have, though, is industry adoption. There's a lot of trucking companies that, literally run their business on a whiteboard. And some of them aren't going to change anytime soon. And so for those companies, you have to do business the old-fashioned way. But I think over time, it will be totally automated. And if you think about financial markets and how, they're still intermediaries, but they're very automated intermediaries. And I think that that's the world that we're headed to. And as I think about the competition, it's a big space, lots of opportunity. I think the propensity for shippers to use a non-asset-based third party continues to increase. A bigger portion of their spend is going to people like Echo. So there's room for, I think the big to get bigger. And I think if you're a small player in this space, you can get big as well, but you've got to have capital, you've got to have technology, you've got to have the know-how, and you have to somehow accelerate to scale so that you can be relevant and competitive in all the markets. So I do think there will be consolidation. And, the old adage that the get bigger, I think there's some truth to that, because the big can afford to reinvest capital into technology and growth initiatives. But I think there are some small players that will do well too, and we'll see how it plays out. But I think ultimately there will be fewer brokers and more big brokers.
Yeah, and the bigger, as you mentioned, my view is that the bigger do get bigger, but it seems like margins or take per transaction may be compressed in the future. Do you adhere to that, or do you think it's always a cycle? But do you think we'll see margins get to the levels they were in later 18, 19?
Yes and no. I feel strongly both ways. I think there will be a longer-term secular compression of margins as people get more efficient and don't need to have the margins that we've traditionally had. However, when you contrast the supply and demand of capacity and the lag effect of pricing, it's always going to create periods of expanding, intermediary margins and contracting margins. Just in the last 6 weeks, we've seen kind of a microcosm of how that plays out, and I know that you know it. When the demand for capacity exceeds supply, the prices go up. Third parties like Echo get our margins squeezed because the price that we pay is going up faster than we can pass through to customers. Likewise, when demand softens or when there's an excess of supply of capacity, the price that we pay for that capacity falls faster than what we charge customers, and our margins expand. So you're always going to have that cyclical aspect that correlates to the supply and demand of capacity. But I think the overall longer trend in a longer time frame is such that there will be some compression of margins in the long term.
Yeah, I actually it was mid-March. I had a conversation with an executive of a newer age a freight broker who had not seen the cycle play out to the degree that they were much smaller when we had the last sort of down cycle. And their comment was, should I be increasing my rates right now when we saw the surge? And I warned them, I said, surge is not going to last. And when freight drops off, it's going to drop off pretty violently. You don't want to be out of the routing guide, because if you have beverage or you have food services or consumer packaged goods, not only are you going to want those volumes, but all of your competitors are going to be calling on those same shippers, and you don't want to be the one that took rate increases during that cycle.
Right. Well, rates are very depressed right now. I mean, it's funny, almost time is being compressed in terms of the cyclicality of things. We've seen rates fall in the last couple of weeks, an amazing amount, but likewise, we saw them expand pretty aggressively at the latter half of March.
What is your message to the trucking fleets, the drivers that are out there, the owner-operators, and the fleets that you guys work with? What is your message to them when you're talking about rate and the current economic cycle of trucking? I mean, ultimately, there's a price for a truck that you have paid because you have a certain amount of margin in it. You guys probably ate a lot of the losses during the last run-up, and now it's the opposite. How do you handle that with your driver population and your fleets that you work with?
We try to be open and transparent. Some of the new technology that we're rolling out will have even more transparency, and the drivers will be able to see the pricing and bid on the loads that they want. But it's really kind of an Econ 101 problem, right? If you've got more supply of something and people are trying to clear their inventory, they lower their price, and unless they collude, which they don't, it just finds its own watermark, and so our profits don't materially change on a load in a tight market or a loose market. The price changes, the price that we pay and the price that we charge changes, but the gross profit dollars or the net revenue dollars per shipment really don't fluctuate all that much. So we just tend to ride the market and take what the market gives us. What we feel in our margins is just sort of that second derivative effect when the rate of change is changing. There's a lag that impacts us either positively or negatively. And you're right. Sometimes we benefit from it, and sometimes we have pain, and we eat the cost, and we move freight at negative gross margins.
Yeah, it's been violent in the past month, but what we've seen at least from our data, is while it's increasing and we're likely at a bottom, it hasn't been this massive acceleration, which is probably healthier for you guys because it gives you time for your customer rates to sort of catch up to the market, assuming we don't see a massive surge.
Well, and there's a trade-off. Like if you look right now, our margins have been expanding the last few weeks because the price has been dropping. But correlated to that is that there's less volume, right? So the very thing that's causing prices to fall is a lack of demand. And so where we might make a little bit more margin per shipment, there's fewer shipments. And the reverse of that's true in a tight market. Our margins will get squeezed because the price is moving up faster than we can pass it through, or we're locked into contractual rates. So the bad news is our gross margins decline, our gross profit or net revenue per shipment declines, but there's more freight. And that's the very thing that's causing the rising prices and the tighter capacity. So where we get squeezed on margins, or we might even have some lost profit on certain loads, we so-called make it up in volume, as they say. And then you get into a point in the cycle where there starts to become spot freight opportunities, and those generally have healthier margins. So for our business, it's trying to read the cycles, anticipate the cycles, price smart, and also strategically, how much of your freight do you want to be contract, and how much of it do you want to come from the spot market?
Yeah, it's portfolio management. I love the analogies of the financial markets. I know you're a student of financial markets and love what's happening. Where do you think this goes in terms of post-COVID? What do you think changes in this industry that is different now than it would have been if COVID didn't exist?
Well, it's interesting. One thing we've learned is when we put out technology let's say, for trucking companies. There are some trucking companies that are eager to adopt it, and the same, by the way, goes for shippers. There are some that are eager to adopt it and jump on the bandwagon. There's some that demand it, and then there's others that just aren't ready for it yet. And it's frustrating for us because, we would love to have all of our customers and all of our carriers completely automated. It makes business easier. It takes cost out for us, and we think it provides a better service product. But, some market participants are just not ready. One of the things that I've seen happen, and it's happened in part due to the kind of the industry focus on the digital freight marketplaces, and I think also that this COVID crisis is going to force it to happen too, is some of those slow adopters are starting to speed up, and they're starting to accelerate their willingness to deal with technology, to go to a marketplace to book capacity. And I think that, ultimately, going back to the financial analogy, you used to want to buy a stock, you would call a broker and you'd place an order. Well, today you go online to E-Trade or any number of platforms, and you do it all electronically, and you get the charts and the graphs and the pricing, and you can see the bid-ask spread, and you can make an intelligent decision. Most of these platforms have analytics capabilities, and I see freight moving in that same direction and ultimately being in the same place.
Yeah, I share your view. We certainly seen the electronic booking. The load boards have started to play a bigger role. I'm curious from your perspective, where you're a big customer of the truck stops and the DATs and other marketplaces. Is there a point where there's a competitive concern, or do you see it more as very similar to the financial markets, as you have the NYSE and the NASDAQ, New York Stock Exchange and the NASDAQ, and then you have these brokers like E-Trade and Merrill Lynch that play as the trading venues. But what is your thoughts on that?
Yeah, we obviously pick our partners carefully. I mean, we do believe that some of these partnerships that you're talking about are important. There's a data component, there's market access for us, and there's access for shippers and carriers to us. But we don't see them as competitors. I don't think they want to be competitors. They have an important function to play in the marketplace, and they play it, and I think understand their place, and we understand ours. And I think the analogy is good to the financial markets. You've got the exchanges, and then you've got the brokerage firms, and I see those companies that you mentioned as being exchanges, and we're the brokerage that manages the buyers and sellers.
Yeah, I can't imagine that truck stop, based on the last valuation, would want to take the valuation of a 3PL in this market versus a SaaS platform. What are your thoughts on valuations in the 3PL market? Are we going to see? Is it going to be a more difficult market in the private equity private sector? Is it going to be more difficult going forward, or do you think we'll see a return to sort of this bullish nature in valuations?
Well, I'll start in the public markets, and then I'll go to the private. Traditionally, public companies had higher valuations than private companies. In the recent year or two, that's not been the case. In our example, one of the things that's an overhang for us is just small caps have been out of favor now for 18 months. And so unless you're a large cap company, and of course the criteria to be considered a large cap company continues to move up over time, you've had the market forces against you. And we're at a unique time now where the private valuations are actually higher than the public valuations. I think that'll change. It always does. It cycles. If you look at the private markets, got a lot of private equity capital and venture capital looking for a place to go to work. This is a big, attractive space. You've got a lot of people that appreciate the concept of disintermediation. You see people, investing in that idea. The idea of automating an old school business, I think, is attractive. The ability to do M&A is attractive. And so for an investor in a private company who's got a lot of money burning a hole in their pocket, plus access to cheap debt without covenants, it's an attractive market. I think that we're going to come out of this, and there's going to be a lot of interest in our space because it's going to be at the bottom of the cycle, and buyers want to buy at the bottom. And so if they can get good valuations, I think you in the short term you might see multiples come down a little bit until the uncertainty clears. But I think the financial engineering formula still makes sense. If you can buy a company that's got good prospects for growth, good prospects to do M&A, good prospects to improve their productivity and their profitability using technology and data science, it's a great investment. And you can get leverage on that very inexpensively these days. The banks are willing to lend, and they make it pretty painless lending. And so I think we'll return back to normal M&A markets once we clear this cloud.
Yeah, it certainly feels like from a financial stock side, as you mentioned, small caps, and particularly transportation stocks have taken a massive beating over the last 18 months, as you mentioned. The nice thing about transportation stocks is they tend to be early in the rally. They tend to come back faster when things are starting to rally back. So hopefully we'll see some bullish signals in the stock market, because certainly we want more capital into this industry, regardless of whether it's in the private sector or in the public sector, because that drives innovation and growth. I'm curious, from your perspective, what are you most concerned about for the rest of the year, for 2020? What gives you the most pause or keeps you up at night?
I just worry about the economy overall. If you think about all the service workers that are unemployed at the moment, and the money that they spend in the economy and the multiplier effect from that money, that's all absent right now. And so when I think about the remainder of this year, I wonder how quickly are those people going to be coming back to work. If a restaurant opens up and they have to have half the number of tables for social distancing reasons, that restaurant's going to do half the revenue, and they don't need as many employees. So I think higher unemployment could be a problem. I think there's going to be business failures, and that's a problem for our economy. So I actually feel very fortunate to be in the industry that I'm in and be part of the supply chain, because frankly, we're relatively unscathed by all of this. There's still product moving. When I think about the overall macroeconomy, there's going to be some big holes in it, and it could be a multi-year recovery. And the impact that it has throughout the economy, because that money's not flowing, is a concern to me. Now, we've had an awful lot of fiscal stimulus, and regardless of your politics, I think in times like these, you need fiscal stimulus to jumpstart the economy again and cushion the blow. So I'm hopeful that has an impact, but got to wait it out and see what plays out.
Yeah, every capitalist has become a Keynesian fan in this market, because $6 trillion going into the economy, and that's $6 trillion in the U.S. economy, not to mention global, which is just adds multiples to what we're talking about here in the U.S. It is interesting, but you bring up a really important point, which is logistics and supply chains. I think people are now more aware about the importance of having a really well-running supply chain, visibility to the market than ever before. And I think that certainly will hopefully create a lot of investment opportunity for both innovation and growth inside the sector.
Yeah, I think when you think about the fact that our healthcare workers can't get masks, and we can't get supplies and ventilators and drugs and all the things that we needed in real time to deal with this crisis, it just speaks to the importance of supply chain, all the way from manufacturer to the end user. And so if anything, it shines a light on the importance of our industry and kind of the need for it to be vibrant and important for the economy. I think what transportation in full is 10% of GDP, and so what we do in this industry matters a lot.
Yeah, Doug, do you think domestic manufacturing and domestic sourcing becomes a bigger part of shippers? Are you hearing that right now?
I don't have any data on that, but I'm hearing anecdotally that companies are thinking a lot about onshoring their manufacturing and getting away from the political and international issues that can disrupt their supply chain. And I don't know if that's good or bad. We buy cheap products from countries with cheap labor, and that's been part of the formula for the last 50 years. But maybe it's time for a change, and if there's more product being manufactured domestically, it means probably more freight. So
yeah, we're both bullish. We're both bullish on that. Doug, one bold call for the next 5 years. Make one bold call, one prediction that we wouldn't expect.
Boy, you're putting me on the spot. Bold call. Well, I think that you're going to continue to see a technology arms race in our industry. I think that the asset-based players are going to jump on board with that. I think that we've been slow to get to where we are with technology, but I think it's going to accelerate. And it's going to accelerate mostly because the shippers and carriers are going to adopt it faster than they have. I can think back early in my career when we did simple things like put LTL rates on a floppy disk and give it to customers, and they didn't have a PC to use the data, and some shippers would say, well, I don't have a budget to get a PC, and it was just this lagging adoption, and with a carrier, it's even more pronounced, especially with a small carrier that's got 5 or 10 or 20 trucks. But I think people are waking up, and it's kind of like a cell phone, right? There was a period of time where it was kind of a novelty, and then there was a period of time where it was a luxury, and now everybody's got one, including fifth graders. I think that you're going to see the rate of adoption of technology accelerate, and it will make the investments that we and others are making all the more important. And going with the technology is the data. Technology on its own doesn't really do much. You've got to have data to drive it, and people like you that are accumulating and aggregating that data is what makes the technology work. So I think there's going to be a technology and a data science explosion, and it will revolutionize our industry, and will look a lot more like those financial industry analogies that we were talking about earlier.
Yeah, I share that. It's going to be interesting to see how post-COVID, as we talked earlier, people going back to work or not going back to work. Also, what happens with the rideshare services? Do they implement autonomous vehicles? One of the things, I was talking to an executive at a parcel company, it talks that this may accelerate drone package deliveries in neighborhoods. You may see drivers and contactless delivery happen with some of the package and parcel services. So a lot to look forward to, a lot happening. Certainly, we hope that your folks are staying well and healthy and continue to serve this country. And Doug, really appreciate you coming in and being a part of FreightWaves Live at Home.
Thanks for having me, Craig. Appreciate it.
Thank you. Really appreciate you tuning in to FreightWaves Live at Home. We're going to continue to provide action-packed conversations like the one we just had with Doug and others. So be sure to tune in. You can also download the FreightWaves TV app on Apple TV. So if you haven't done that, it's a great time to do it. And if you've missed any of the conversations, they are available on demand on tv.freightwaves.com and on the FreightWaves TV app.